So a lot of people are skeptical that you can actually make money with apartment buildings, especially when you're syndicating them, which means you're raising money, right? Because now you got to find a deal that not only pays your investors, but also pays yourself. And people have this misconception that they need to find this crazy value add deal where they can double the value of the building in 3 years and cash everybody out and make money. And certainly those are nice and they happen, but that's not what we need with multifamily. One of the things I like about multifamily is that you get to passive income and long-term wealth with a bunch of base hits. And I'm going to show you a case study right now to demonstrate that. We're going to buy a 20-unit building at a 7.5 cap, which you can get in many parts of the country, and the rents are about $150 low, but we're only going to raise them by $100 a month over 3 years, okay? That is not an outrageous deal at all. And I'm going to show you the result of that, of how much passive income you can make, and as well as how much wealth you can build with a deal like that. So I'm going to switch screens over here, and I'm going to kind of go through that case study with you right now. All right, let me set this deal up with you here. What we're looking at here is a Syndicated Deal Analyzer. It's an analyzer used to model apartment buildings with a focus on raising money from others, which is essentially syndication. So you can just Google Syndicated Deal Analyzer to find it. It's very affordable as well. But let me just set this thing up here. So this is a 20 unit. Asking price is 1.1. We got it under contract for $877. We're putting something down. Now, interestingly here, we're paying ourselves a 3% acquisition fee at closing for putting the deal together. Now, we do need about $2,500 per unit. And the rents are about $150 below market, which we verified with our property manager. And what we're going to do is we're going to project an increase of rents by only $100, and we're going to take 3 years to do it. I'm doing that only to make a point that I don't need a home run to actually make this kind of deal work. The other thing I want to show you is that we're buying this thing at a 7.5 cap. A 7.5 cap is not an outrageous cap rate, and you can get that in many parts of the country. So it's not like you need to get something at a 10 cap. All right. So those are my 2 points: is fair market value for a deal, and slight tweaks will result in what I'm about to show you here as well. So just here's some of the financials. You know, we have, this is 143 in income, 10% economic vacancy, expenses are 50%. That's all good. We're actually buying at a 7.5 cap, and we're projecting selling around the 7.5 cap if we ever do. Now we're going to do a 70-30 split with the investors. The investors get 70%. You as a syndicator gets 30%. All right, and we're going to have to raise $350,000 in this case to get the deal done, including your acquisition fees, down payment, and closing costs. All right, next I want to model the upside in rents. So we're starting at $600 a month in rent, which is what the current owner is getting right now, and we're going to get that to $712, about $100 more over the course of 3 years, and that's the only quote value add that we're doing here. Is we're just raising rents. Now we're paying for it. We're putting $2,500 in per unit on average. Some have already been renovated in this building, and some have not. So we're going to put about $3,000 or $4,000 in per the ones that have not been renovated yet to capture that. But it's an average of $2,500, and we already modeled that in the summary tab. So that's really the only thing that we're doing. So let's take a look at the impact of that. So we can see here that the overall average annual return, and we're selling this in year 5 is the way we're modeling it, the average annual return for the investor is about 16%, which is a great return. If we can be up above 13%, 14%, the average investor is very happy with that kind of average return. So let's break this down a little bit here for the investor. This means that if we're selling in year 5, this is the member cash flow they're getting each and every year. It starts off with a kind of a low cash-on-cash return, and then starts picking up around years 3 when we have this up to our target rent, and we're approaching a 10% cash-on-cash return, which is really where we want to be with investors. Now we're selling this in year 5, but you don't have to. As you can see here, the cash flow just slowly keeps returning. I'm just showing you what this looks like, just to show you something. So, and then you can see here the average annual return is with a sale in year 5 is just 16%. So the investors are very happy. Now, so investors are very happy. It's amazing. And now let's take a look at what you as a syndicator is being paid. You're being paid an acquisition fee here of $26,000, I think, right? $26,000 is the acquisition fee. You're getting that in year 1, and then after that, you're getting about $9,000 to $13,000 in cash flow. It's about $1,000 a month on these 20 units, and that's with you having none of your own money in the deal. And then you're getting paid $62,000 when you sell this in year 5. Again, with none of your own money in the deal. So here are the key takeaways from today's lesson. Number 1 is deals bought with investors can actually cash flow and yield attractive returns for both the investor and you. Number 2, you don't necessarily have to buy a killer deal, guys, okay? You can buy at fair market value. Just make sure you buy on actuals, not on some kind of pro forma. You can buy a fair market value deal, and if there's some kind of upside there, the numbers can work, but you don't have to look for a home run. So that's lesson number 2. And then the other lesson, as I was talking about, is raising money from others lets you do as many deals as you want. So really, really learn the skill of raising money. And also the 4th lesson is that raising the income or lowering the expenses, whatever, just a little bit can have a huge impact. And we just showed a small 20 unit here. Imagine doing this for a 100 unit, right? So even increasing the rent by $25 or $50 can have a huge impact. If you're interested in finding out more about apartment building investing, make sure you go to my website, themichaelblank.com. And especially if you're interested in analyzing deals, more information about that, there's an ebook I have all about the 10-minute offer and analyzing deals, and that's at themichaelblank.com/analyzer. So THE, Michael, BLANK /analyzer, and you get to the ebook download page for that one. All right, guys, appreciate it. Thanks for your time and attention. I'll catch you next time. Hey, thanks so much for sticking around to the end of the video. I want to leave you with 3 next things to do. I'll give you a quick tour of those, and I'll tell you how to do them. Step number 1 is to download my free ebook, The Secret to Raising Money to Buy Your First Apartment Building Deal. It is an awesome ebook full of tips for raising money and how to do that. So that's number 1. Number 2 is to subscribe to my YouTube channel because I put out new videos all the time, and I'd hate for you to miss it. And number 3 is to watch the next video in line. All right, so what you're going to do is you're going to click on the first thing, which is to download the ebook. That'll open up a new tab. The video will stop playing. You're going to get the ebook, and then go back to this video, and then click on number 2, right, which is to subscribe on the channel. That'll open a new tab, and then you can go back to the 3rd one and just click on the next video in line. All right, so hope you find that helpful, and I'll see you in the next video.